Hello, everyone, and welcome to the first session of Financial Accounting Essentials. My name is Chen, and our team has mastered your courses so you can enjoy your smooth ride to the Dean's List. Let's get started. Feel free to pause, rewatch, or even slow down the videos for more clarification. And you can always check out our website for notes or even book a private tutoring session for you and your friends. So this session, we are going to cover the balance sheet, which is the financial position of the company, especially on what it does, what it has, and how to utilize it to your absolute advantage in the exams. So aspects in the balance sheet can be categorized in three different categories, which are the asset, liability, and the equity. Assets in the balance sheet are essentially what the company owns and uses for its financial gains. So let's say cash, the company building, company car, equipment, or even investment in other companies can be considered an asset because you own it as a company. Liabilities in the balance sheet are what the company owes either to themselves or other companies. So what that means is maybe loans issued from the bank, that is a liability because you are owing someone something. Or let's say you are paying your suppliers or clients, but you don't have the cash at hand, you can issue an IOU. That is also categorized as a liability because it's something that's payable in the future. Or even provisions that you set up in case something bad happens, like legal issues or damages that you are predicting. That is also a liability because you are going to pay it back later on in the future by taking money out of your own bank account. And equity in the balance sheet represents the value of the company in the market. So that can be achieved either by issuing shares to shareholders, private equity purchases, or even financial performances of your company through operation. Obviously, all of these things might sound like a bunch of jargon, and it's really hard to understand them and apply them to a real test situation. Don't worry, on our website, we have a categorization chart that's categorizing every single thing that you will see in a balance sheet into these three categories so you can better understand them in the test. Now we know the three categories of balance sheet, it's time to get more in depth on the subcategorization. Let's put this in a real life example. So let's say you have a company and you want to sell your office building. In order to sell your office building, you will have to, first of all, get an agent to value your building so you can be on net book value, put it on the market, find someone who's interested and really sign the contract and seal the deal. That's going to take months or even years to complete. Therefore, non-current assets are essentially assets that you can have in your company, use in your company, but not necessarily liquidate or get rid of from your company as easily. So tangible assets are essentially assets that exist physically without the need of other assets assisting it. So what that means is they are assets that you can physically touch, see, or even use without needing a contract or some other asset for it to exist. So examples of tangible assets can be, well, again, cash because you can physically touch the cash, or equipment or buildings because they physically exist at their establishments. Intangible assets are essentially the opposite of tangible assets, which means that you cannot touch, feel, or use the product without the help of another asset or legal binding contracts. Examples of that can be accounts receivable, programs that you use for your computers, or even patents that your company issued to secure a product under your company. So non-current liabilities are liabilities that last in your company for a longer period of time, as its name entails, because either it has a very large amount to pay off or the procedure is a bit more complicated. An example of non-current liability can be a long-term loan issued from your bank. Because the value of the loan is so high, you can't pay it off immediately since you don't have that much cash at hand right away. Therefore, it's going to take you maybe 5, 10, or even 20 years to pay off the whole entire loan. Therefore, it's categorized under non-current. Obviously, these subcategorization guides can also be found on our website where you can see all of this stuff in the balance sheet being categorized under each different methods. Now you know the basics, especially on what's in the balance sheet and how to use it. It's time to move on to the golden rule, which is that total assets equals total financing. So I know what you're thinking, don't get blown away. Total assets and total financing, we never mentioned that before. However, it's pretty simple once you know what there is to know about balance sheets in general. So what it basically means is that total assets, the uses of your finances, is equal to your total financing, the sources of your finances. What it means is that where your money goes is from somewhere. You must get that money from somewhere in your company, either through issuing loans or issuing shares. So in a test scenario, just make sure that your assets are equal to your liability and equity added together. Then, if you put the right addition and subtraction into the right accounts, which are offered on our website, you will have a beautifully balanced balance sheet and one step towards having a perfect score on your financial accounting exam. Well, that's all you need to know about balance sheet, especially on what it does, what it has, and how to use it to your absolute advantage in the exam. I hope this video helped you out, and if you want more, definitely check out our website for more resources, or even book a private tutoring session for you and your friends. Again, I hope you enjoy this, and have a good day.